Good morning, everybody. It is April 5th. We're in the second quarter of the year now, and this is the weekly review, the broadcast where we take a look at what happened and try to use what we see to project what to look for next. If we look at last week, if you remember, we came off. Let's actually just pull up a chart. We came off the consolidation that took place way back to begin the year, right? And in February, you got that mild pullback that then led to the breakout. But then they reeled it back in, did a retest, regenerated back up, but failed to get the new highs, at least here on the S&P 500. Pulled back hard, right? And now we're in this choppy gyration that's taking place at this particular point in time. What does this tell us? Right? I mean, what are we seeing here that tells us, if anything, tells us something, right? And if I look at the weekly, remember last week we had a takeaway bar on the weekly, and now we're just hanging here. Now, as we'll talk about a little bit later, the concerning part about all this is the structure is being built out again. And that structure I'm talking about, of course, is the swing points on multiple time frames that, if they break, then potentially they can lead to something larger. We've got this little area here that's going to try to break this week, which could bring us down into these swing point lows that exist on the weekly time frame. This swing point low down here more than likely will end up being a swing point low on the monthly, and there will be multiples here on the weekly. So, if we think farther out, 2 months, 3 months from now, if this market cannot get its mojo and start heading back up and start breaking higher, then we have the prospect of A, this area breaking, and B, coming back down here to test all these swing point lows on not only the weekly but the monthly. So, that's the structure I'm talking about. That's the structure that, we just have to keep an eye on and continue to evaluate as this market unfolds. We know we've been on a huge run for a very long time, and I had pointed out, several weeks back that we're going to see this move to a nosebleed type level, right? An overbought level, where I shouldn't say overbought. We're going to find that MTTF, the cumulative probability of a failure, right, at the 70% level, excuse me, somewhere out in the June, July timeframe. And it's going to take, this a while to roll over if it's going to roll over. And so we may see, this, get up. Again, going back to look at the chart here, we may see this hold and continue to build out some sort of a sideways structure up here until this becomes more oversold, or a higher number, I guess. Sorry, folks, I'm a little tired today, and I apologize. I've been sick the last few days, and so even though I'm doing my best to present good material, I keep saying words that I don't intend to say just as a result of my inability to get a good night's sleep here of late. So anyway, that is that setup. That's the concerning setup. Just something to keep an eye on. It's nothing that's affecting us now. Now, if we see, just looking at this one more time, if we see this break this week, and given the employment number that came out Friday while we were closed, we may see, or we probably will see, pressure to try to break this early this week. And when we get to the economic numbers, we're going to see we got central banks galore this week, and then we've got earnings starting to peak at us towards the end of the week, Wednesday and Thursday. So we've got a lot of stuff again that's going to give this market problems, or potentially give this market problems. On the flip side, we've got the positives in that, in particular, the rest of the world is up there hitting new highs or hanging at the highs. And so it's very hard to get a hard sell-off here with that happening there. And more than likely, the earnings are going to be the next big catalyst. Last week, really nothing happened. Russell was the strong one. And the thing about the Russell that's interesting to me, it reflects the fact that nobody wants to leave the market. And I think that is a reflection of the fact that nobody has any place else to put their money. I mean, where are you going to put the money if you are not in equities? You know, you can't, or at least it feels like you're taking a big risk on bonds. It feels like you probably, you know, it's hard to rotate too much more money into overseas markets given the gains they've already experienced to date. It's just a question of, okay, where are you going to get return? You can't get return anywhere unless you take a lot of risk, and that means you got to stay in the market. So what do? They rotate it, and that is a reflection, I believe, of that rotation. Well, holiday shortened week. So let's just review what happened. The holiday shortened week last week, you know, we had the bounce that tried to come into these markets on Monday, and you can see it here on the S&P 500. You know, but they couldn't hold it. They just simply could not hold that bounce, and instead they sold it right back down the next 2 to 3 days, right? So we essentially ended flat on the week. The bounce attempt after the drubbing the week before really didn't get going. And if you remember, you know, I had talked about the way that you get the larger move out of here. Remember, we were range trading for 2.5 months. Was that we would go to test, pull back, and not come all the way back down, but instead get the bounce that could give us the breakout. And of course, that is what happened. Matter of fact, I had mentioned that, you know, right here. That is what happened. Got that extension, and then it reeled us back in again. Now, the downside's no different. The way you're going to get a larger downside, you know, you come down, you go up, you come down, right? You go back up, and instead of going all the way up, you only go part of the way, and then you get the break that takes you down to the backside of this again. So that, you know, if you think about it, that's kind of the way this thing is trying to set up right now. And if it does do that, then we could get down here and build out this larger, even larger range again, right? Because this large range we had before, right, is nothing like this one, which is what would be taking place if we come all the way back down here. So, you know, we've kind of got two large ranges here potentially, and you know, I don't know if we're going to get there. I certainly don't know if we're going to get there this week. We're probably going to test it off that employment number tomorrow, and we'll see if we get the break or not. But that structure, right, is setting up to try to take us down to this bottom of the range. If we look outside the S&P 500 and we look over at, say, the NDX, let's look at the NDX next. The NDX is set up basically the same way. It's got essentially the same pattern. And the thing that these are doing that's not happening in the S&P 500 are these are doing bullish retest regenerates. So they're coming back, right? They've already tested here, and now testing a third time. 3 times usually is the charm. That to me is not a good picture. In other words, if you can't get up and get going and you keep coming back, whatever buying support is here slowly gets eaten away, and that's kind of where this one's at. So that to me is a negative when I view it that way. If we look at the Dow's doing the same thing. Here the retest regen zone's a little bit different. You know, you had the large one here, and then you got this one inside of it, and that one continues to get tested over and over and over again. The Dow looks kind of like the NDX in that it wants to give it up. Now, on the positive side, if we go to the stronger indexes, the Russell and the NASDAQ composite, here you can see the bullish retest regen hasn't even begun to occur yet. So in other words, if we are going to get some sort of a push down, I suspect this one and the Russell are going to be the ones that find the support on that retest regen off that prior high, because remember, we've gone way more than 6 bars without a retest. And if you look at it on the weekly as well, and I didn't point this out on the others, but if you look at it on the weekly, that would be a retest regen on this bar on the weekly. Moving to the Russell, the Russell has an even stronger presence. In other words, if we look at it, it had tested on the weekly, on the daily, it had tested this area, popped back up, and it's almost back to the top of the breakdown bar. So the Russell much stronger, and we saw that in the opening numbers where it was the only index that posted gains last week and held them. The Russell much stronger. If we get weakness elsewhere, it would be another retest regen on this time frame. If we look at it on the weekly, there was an attempt to test back into this again, into these swing point highs previously. This has, as you can see, pushed back up and it's holding up here at the high. So Russell composite, they say, hey, if we get a pull down, in other words, and I'm going to go back one more time here to the S&P. If this S&P breaks this area and starts to push back down, those stronger indexes, as they pull back to support areas and get bought, this one's probably going to get arrested. So I don't expect us to break these levels, certainly not this week, and probably it's going to take a little while before they do break, if they're going to. So there's a little bit more time from that perspective. What are the negatives? Actually, I just kind of went over most of the negatives. If I look at the sectors, though, there's some negatives in the sectors. And these, actually one of these is very perplexing, and that is the IYT, because the IYT really should be doing a lot better than it is. And here we've got an ABCD structure that's starting to take place that looks like it's going to try to break on the daily time frame. And you can see, it's coming right to it right now. That's the low. If it breaks, it's going to break this swing point low, this swing point low as well. It's a large structure to take it farther down. And if we move to the weekly, it's a break on multiple time frames as well. And it would be one of the first major indexes from this period of consolidation we've been doing to actually start breaking down on multiple time frames. If it does it, you have to ask yourself, what is going on? I mean, of all the sectors that should benefit from the collapse in oil prices, you would think the transportation sector would be one of those. Yet this thing can't get off the dime. Just tells me that the structure in this market, in terms of, and I'm talking about the economic structure, in terms of expanding cells, we've known for a long time, it just hasn't been there. We've manufactured and engineered, financially engineered the earnings for so long. This is just a reflection of that, hey, the cost structure, even though one part of that cost structure for the company is dropping, the demand for their product just isn't enough. It's just not there, right? If it were, you wouldn't see this, I guess, is what I'm trying to say. In other words, we would see, one component of the cost structure coming down. If demand were equal, wasn't decreasing, then the rest of the cost structure would flow to the bottom line. They'd make more money. Yet the stock doesn't reflect that. So either it was overvalued to begin with, or worse, it's worse off than we think, right, in terms of their earnings per share. Let's beat that to death. Let's go somewhere else. And that somewhere else in my mind is the other part of the Dow theory, which is the industrials, right? So we've seen, the transportation's unable to make a new high. The Dow theory is, you make a new high in one but not in the other, and then you eventually make new lows in both of them, which kind of says, hey, the market's done. Now that's the Dow theory. I don't subscribe to it, completely, but I certainly stay abreast of what's happening in it. The XLI, of course, is a reflection of the industrial sector, and a more true reflection than the Dow itself anymore. And if you look at that industrial sector, this too is setting up to try to come back down here and test these lows. So in other words, we're coming back down here. You got two lows here. You're setting up the potential, break, and that will take it right down here to test these lows. And so, I'm starting to see a couple things here in the sectors that is concerning, and it's concerning from the standpoint that, wow, two of the sectors that really shouldn't do this, show this kind of weakness, is in fact doing that. Probably the most disconcerting of all things is that the general market, the breakouts, the high probability trades are failing. And we've seen this in the portfolio, and I'll just skip to the portfolio and look at it real quickly. With three of the stocks that we have in there, we're seeing this occur more and more. And it's not just in these stocks, but these happen to be ones, of course, that we've been looking at. Let's just look at two or three of them real quick. Facebook, breaks out on multiple time frames, yet it comes back immediately to do a retest regen. That's not what typically happens. KeyBank breaks out multiple time frames. What does it do? Comes back immediately to do a retest regen. And then the other one was eBay. eBay, same case, right? Breakout, multiple time frames, and then it just looks like crap, right? Comes back to do the retest regen. Now, in a couple of these, yeah, there was a higher high. Yeah, that's a problem. That can lead to this sort of thing. So in other words, there was other resistance up above. But, in the market that we'd seen the last 3 years, that wouldn't stop it, right? These things would have continued higher, but they're not. And that part of, the behavior that we're seeing probably says more about this market than anything, and that it's really a lot weaker than it looks. On the positive side, the NASDAQ we talked about above, or previously, the Russell, these are positive on the technicals. On the fundamentals, the world is awash in the ZERP and the QE policies, and the Fed with the employment number now, they being the market, is basically priced out a June Fed hike. There's just no way, they say, and it's going to be September or even 2016 now. The Fed is being forced to stay in this world. And there was a comment on one of the articles I wrote on MarketWatch about a Fed QE liquidity trap, which was kind of interesting. I hadn't seen that before, and I'll find the article and make a link to it for you. It was a good article, and I'll post a link to it on the site. The other positives, right, are kind of if it's not bad, it makes it good. Well, it's kind of one of those for this, right? Investors don't have any place else to put their money. If you're an investor and you have money, you either sit and get nothing for it, or you put it at risk. And there's really no other place to put your money. Most of the big moves around the world, they've already taken place. There's not a lot of places to go put your money without a lot of risk, and that's the way this market is. And that helps the market as long as that perception is that you have to take the risk. Of course, when that changes, things get ugly very quickly. We've got earnings coming up. I'm listing it as a positive because they're so negatively viewed and publicized at this point. So, we have seen article after article. I started talking about this quite a while ago, 6 months ago, that first quarter was going to have bad earnings. Second quarter probably going to be just as bad or worse, and they are. And the rest of the world is keyed in on this. And when everybody knows it's a problem, then it gets priced in. And I'm sure it's been priced in to some degree already. Question is what's that guidance going to look like? This is going to be the key, right? Guidance. Do they guide higher, or do they even guide lower than expected? And if they do, then we could get more selling. But right now, you have to think that, hey, this has been discounted to a great degree already. What's the fundamental negatives? You know, employment numbers, just the latest. We've seen report after report after report that tend to suggest that not just here in the U.S. but around the world, things aren't getting all that much better. We've seen the bump up in Europe statistics, but that's all expectations based on QE, in my opinion, and that will dissipate before you know it. Everywhere, unless we're getting central bank intervention, things are not getting that much better. Period. It's just not happening. And that continues to be probably the most fundamental negative out there. Transports we already talked about. What would I watch for this week? I would watch for that breakdown in the transports. If that takes place and we see the XLI as well go down to test those lows, it's just another indication that it's getting more and more dangerous on a longer term perspective. Early releases of earnings are going to be key this week, and I've listed the primary ones I'll be looking at. The real earnings start hitting next week, next Tuesday, I believe. These are the only ones this week that look like they'll give us any kind of a tell, so I'll be watching those closely to see what the reactions to them are. If we look at the economics, the central bankers, it's all about them this week again. We got Fed speakers Tuesday and Friday, and then we got a bunch of policy announcements: Australia, India, Japan, and then Great Britain as well. We got Fed minutes on Wednesday, and we've got some Japanese minutes on Saturday, and there's a few PMIs as well. So you know, it's all about central bankers this week. That will be the bottom line in terms of the economics. And then if we look at what we think the bottom line is on the markets themselves, you know, I think you have this perfect storm of positives and negatives that are going to keep us gyrating, you know, building out this larger range. And when I talk about the larger range, you know, I'm reflecting on, and I use the S&P again as the mechanism, you know, building out, and I'm going to go to the weekly, building out this larger range. And I'm talking about this one, right? This looks to be what's building out. And if we do get the break here, right, then you kind of got these two ranges, and then we'll be trying to work, you know, lower in this lower range. So to me, you know, that's where this perfect storm has left us, in that we can't get higher, we can't get lower yet. It's just, where do we play out inside this big range, and do we build out the bottom of this big range again? And my, you know, suspicion is over the next few weeks, that's exactly what we're going to do. And that's going to set up this more ominous structure if in fact it plays out that way. Okay, and then one more thing, you know, most of you know that I've done a lot of work identifying, you know, the multiple time frames, you know, the common characteristics that make stocks, you know, trades potentially great, either up or down. And a lot of it has to do with this multiple time frame break stuff that we've talked about. One thing I've been working on for a while now is trying to understand the common characteristics of these larger declines. Because as you know, I talk about there being a necessary but not sufficient condition for this, you know, when I talk about this. For example, if we come down here and we potentially will break these, you know, that's a necessary condition, but it's not sufficient. In other words, we don't have to. And so one of the things I've done is I've set up the structure for me to go back and to view these charts just like you're viewing these now, and you view them, you know, currently, at least for me manually to go back and say, okay, what did the world look like back in 1962 on the 3 time frames? And what did it look like, and for me visually to do that with the charts. And I started going back, all the way back to all occurrences of break points or break transitions, right, from a bullish to a sideways trend ever since 1962 on the S&P 500, and we just got one in October. And to look at those and say, okay, what did the declines look like? This is the decline line. And what was the percentage loss, right? Let me just scroll this over a little bit. What was the percentage loss if you just got out of the market, you know, once it broke on went from, you know, bullish to sideways, and if you stayed around until it went from sideways to bearish? You know, what was your max loss in that case versus top to bottom loss in the market itself? And so I've started to identify what these things look like, and to look at those, each of these occurrences, and to look at them and say, okay, what are the common characteristics of these major declines now, so that we can narrow down that window of the common characteristics that we can look at outside of just the break of multiple time frames and just the transition from sideways, or excuse me, bullish to sideways. And so I'm in the process of doing this. Of course, when I get done, I'll share that with you. But it's a, you know, what my desire is to know, you know, for example, wouldn't it be great if I had a higher probability of saying, hey, this potential structure that's in place right now, while we're still way up here, not when we get down here in transition, but while we're still up here, what is it about this that tells me that this has a higher probability of happening, and knowing that up here somewhere? That's what I'm trying to answer. And, you know, I don't know if I'll be successful in being able to narrow that down, but if I can, that's a huge benefit. And, you know, my trader's instinct a lot of times is what I rely on, you know, just the sense of what's happening in all the various markets, just like we're talking about the transports and the XLI. You know, those are kind of auxiliary information, you know, data points that are coming in that give you a sense of what's happening. But I suspect that structure is apparent as well, just looking at the indexes. And so one of the things I'm going to be doing is trying to decide if that's true. And of course, I'll give you the results of that feedback, or that research. I'll feed it back to you as I finish it. Not much to say about the portfolios. I've already kind of covered the 2 or 3 that are there. They really didn't go anywhere. We're still up on the year, but you know, we gave back a lot of those gains 2 weeks ago, or gave back a good chunk of them. So, you know, my intention here is to stay, you know, a very small footprint to the long side, because I suspect that, you know, there is the danger of us actually breaking down more. You know, one of the things I did mention in the Friday posting of the portfolio was to look at, you know, in particular Hong Kong as one of those overseas markets that we might be able to invest in, you know, and take some exposure elsewhere outside the U.S. markets. Now, you know, we had traded in a couple of those weighted ones, you know, in Europe and in China proper, and it made some gains on them, but took our profits and took them too early again. But this is one that's non-weighted, and it's you know, it's breaking out, and we can look at it on each time frame. You broke out here on the weekly, and at the monthly you're up here near the highs. This thing has gotten a lot of momentum, and because it's not weighted in terms of the currency, that's not hurting it. As a matter of fact, with the dollar kind of stabilizing, it seems to be working in its benefit, not its detriment. So I'm looking at this. Of course, I'm wary of the retrace and the potential failure on the breakouts. But this one actually had the breakout, the retest, regen, and then gapped up and is holding. I'm going to be looking at this week and seeing if there's a trade here that we could put on, and again try to diversify away from just the U.S. markets as a place for us to put on some exposure. So that'll be this week if we do it, and we'll see how it plays out. I'm going to leave it at that. You know, hopefully that gives you a good feel for where we're at. These markets, you know, if they're treacherous right now, because, and I'm talking about the U.S. markets in particular, because there's a lot of up and down. And that up and down, if you can use it to your advantage, it can be very profitable. But if you get caught up in it like we did 2 weeks ago, and you're trading or attempting to trade larger and with smaller margins of error, then you get thrashed. And so the danger right now is the thrashing. And then of course the larger danger is down the road here is that we're actually putting in some sort of a larger top and are going to fall back down and actually do some larger declines, which we haven't seen in 3+ years. To me, those are the things that are out there that makes me want to keep my exposure fairly small, at least for a while longer. And if it does look like we in fact are putting in a top, then we really have to look at the short side, not just the long side. And that will be something we'll be evaluating in the weeks to come. I'll leave it at that. Thanks a lot. Take care, and I'll talk to you this week.